There's been an explosion in the reverse repo market, and will this lead to the next economic collapse? I will be asking my guest today, George Gammon. He is the founder and the host of the Repo Capitalist Show. He also runs a yearly conference. Please welcome him to StansberryInvestor.com. George, good to finally speak with you.
Likewise. I've watched so many of your videos and so many of your interviews, and I absolutely love them. And it's really an honor to be on with you today.
Likewise, George. It's funny. I've had so many people saying, why haven't you had George Gammon on yet? So for all those folks out there, here he is. I'm sure this is going to be an incredible conversation you're going to watch time and time again. Reverse repos. People out there might be like, yes, a topic I want to learn about. Others might be like, what the heck is a reverse repo?
Right.
For the folks out there thinking, what is that, otherwise known as RRPs?
Yeah.
It's basically the opposite effect of QE, if I had to really water it down.
When the Fed does it.
Right, when the Fed does it, they absorb cash. So basically, like I said, the reverse of QE. Why should we be paying attention to reverse repos, George?
Well, I think it tells you about the counterparty risk that's potentially in the banking system right now. So we go back to September 2019. And I would assume most of your viewers remember that the repo market, the big news was it spiked up to 10% interest rate and would have taken up all other interest rates with it, including the Fed funds rate. So the Fed had to step in and just do what they do and bail out the markets. So back then there was a lot of debate as to, why did that happen? Was there too little cash in the system? Other people argued that there was too little collateral. Other people argued that it could have been a counterparty risk, a systemic system, or a systemic risk where the counterparties in repo, just no one wanted to lend to them, kind of like a GFC type thing with, think Lehman Brothers as an example. And now we've got something that's a similar anomaly in the sense that the Fed is doing these reverse repos. And I'd like to point out that this is not the entire repo market. But the Fed now is doing a significant amount of them. It's unprecedented. And in fact, just the other day, the reverse repos where the Fed was the counterparty got up to almost $1 trillion in one day. It was 991 billion. I mean, that's absolutely staggering. So if you listen to the mainstream media, they'll tell you that, oh, well, the Fed's been doing all this quantitative easing, which basically means they're buying collateral, they're buying treasuries, mortgage-backed securities, which means the system has more bank reserves, or let's just call them dollars, which is the way most people think of bank reserves. So the system has more dollars and they need to park their cash somewhere. So they're just going to park their cash with the Fed. That makes absolutely no sense whatsoever. First and foremost, the quote unquote dollars are already a liability of the Fed if you're looking at the primary dealer banks and the banks that have accounts with the Fed. So let's say JP Morgan, let's use them as an example, right? Well, their dollars are already at the Fed in their reserve account, making 15 basis points. We call that IOER, interest on excess reserves or interest on reserves. So that's at 15 basis points. So why would they do a reverse repo with the Fed where those reserves go from making 15 basis points down into another account, which is still a liability of the Fed, but that's the reverse repo account, where they're only getting 5 basis points? You see, that in and of itself doesn't make a lot of sense. So then you would say, well, maybe it's not just these big banks. Maybe it's the money market funds, which probably a lot of your viewers and just the average Joe and Jane out there would be putting their money into, just thinking it's a safe way to get a couple extra basis points above and beyond a savings account. But what they don't realize is the money market fund managers are going directly into the repo market and lending your dollars to Deutsche Bank or HSBC or someone that's very shaky, to say the least, when you look at their balance sheet in the derivatives book. So now what they're doing is they're taking that cash and maybe moving a majority of it over to the Fed. And you say, okay, well, why would they do that? So the argument that there's too much cash in the system really doesn't make sense, because those money market fund managers could get 5 basis points elsewhere. Right. And the big thing that people need to understand, and it gets a little esoteric and complex, but I'll try to break it down. And normally I just kind of glaze over this, but it's really important that people get it. Dollars in the system, other than these green pieces of paper, have to be a liability of a bank. The question is, are they a liability of the commercial banking system, or are they a liability of the Fed? So your bank account that you have, let's say it's with Bank of America or Wells Fargo, your dollars in that account would be a liability of that bank, so of the commercial banking system. But JP Morgan, or let's say Goldman Sachs, their account they have with the Fed, those dollars aren't going to be a liability of the commercial banking system. They're going to be a liability of the Fed. So that really matters, because when these money market funds are moving all of their dollars over to the Fed, what they're saying is, with their actions, is we don't want our dollars to be a liability of the commercial banking system anymore. We want our dollars to be a liability of the Fed. So then you have to kind of scratch your head and say, well, why is that? Why do they not want their dollars to be a liability of the commercial banking system? And there's another great argument that it's a collateral issue, which means that in a reverse repo, they're giving their dollars to the Fed. The Fed is giving them a T-bill, as an example, or a mortgage-backed security or a treasury as collateral for the transaction. And then the next day, or whenever they, the maturity of the agreement, then they go ahead and trade back. So maybe it's these money market fund managers want the actual collateral. Maybe they want the T-bills, because they can somehow take that and turn it into a derivative, or they can somehow get a increased yield on having that T-bill instead of having the cash, right? Well, that doesn't make a lot of sense either to me, because the money market funds, I don't know that they're the ones that are creating all of these big derivative products. That would make sense if it was a JP Morgan, or if it was one of the quote unquote banksters doing this, So if the money market funds really aren't in it for the collateral, then again, you have to kind of scratch your head and say, well, why are they doing it? And the first thing that comes to my mind is just that they don't want to deal with the counterparty risk involved with either having their money in the commercial banking system, or by going into the normal repo market and lending that cash or those dollars to another bank or another financial institution that's in the system. It's very interesting in the sense that it could be for the exact same reason that we saw the blow up in September 2019, but the crack in the system is just showing up in a completely different place.
So two things really stick out to me here, George. One, it's shocking to me that we're not talking enough. I know your show does, but we don't talk enough about the impact of the reverse repo market. I mean, you don't see this on mainstream media. And two, basically, if it's closed in on close to $1 trillion, it's basically wiped out 8 months of QE. What, trickling down, what are the repercussions of that to us?
It could be massive deflation in the form of asset prices. And here's why. And this is something that I don't think too many people really get either. Well, let's go back to when we were talking about the dollars being a liability of the commercial banking system or the Fed. So if they do the money market funds, let's say they're 100% of those reverse repos. And let's say 100% of those money market funds do not have accounts with the Fed. So those dollars start off as liabilities of the commercial banks. They're taking $1 trillion out of the system. So in other words, broad money supply, M2 money supply, the dollars that are circulating in the economy chasing goods and services goes down by $1 trillion. Now granted, those aren't really circulating with a lot of velocity, because they're in the fund, but that's sucking liquidity out of the system. Now, I'm not saying that people need to be prepared for the prices that they're paying at the grocery store to go down in price. I can almost assure you that's not going to happen.
Because a lot of people would say, George, that's not a bad thing if that would be the consequence.
Right. No, I think that means that there's the headwind for asset prices moving down into the future. So the stock market, real estate prices, and there's another reason for that. And this is an even bigger reason, because when the money market funds move those dollars from the commercial bank over to the Fed, the bank reserves go from the reserve account of the original bank who had the dollars down into the reverse repo account. So let me just walk you guys through it just so everyone's on the same page here. So let's say this money market fund manager had $1 billion with Wells Fargo. Wells Fargo would have $1 billion liability, but then they'd also have $1 billion asset worth of bank reserves held at the Fed. So when that money's transferred over, the money market fund's account goes down to zero because they move the entire $1 billion. But then those bank reserves, the asset that matched up with that liability, go down from the Wells Fargo's reserve account down into the reverse repo account. What does this mean? This means that the bank, the original bank that held the dollars, their lending capacity has gone down. They cannot generate as many loans because they don't have as many bank reserves. To your point, the opposite of QE, right? They don't have as many bank reserves to use to back up additional lending. Well, as most of your viewers know, the way that dollars are usually created is through the banks lending them into existence. So if they have less lending capacity, that means they can lend less dollars. So you have another kind of headwind for inflation with the lending capacity, the entire banking system going down as a result of these repo transactions, especially if they stay permanent at this level. There's a lot of cross currents there, but the main takeaway is that if the system stays like this, I think what's most important for your viewers, because they're probably asking themselves, okay, George, I get it. It's esoteric. It's rather complex, but what does this mean to me? Does this mean we're going to see inflation? Does this mean we're going to see deflation? And what I would say to them is if the system stays as it is right now, I think you'd see this big spike in inflation that we've seen over the past, 6 or 7 months, but we might see that the rate of inflation decrease slightly moving forward. If these reverse repos stay and if this liquidity is continued to be really sucked out of the system. And that's where I think the Fed would step in and they would need to take further action. And I can explain that to you if you want.
Yes, I'm interested to know how that would play out on the Fed's part, what path they would take. But getting back to a deflationary scenario for those assets. So my question to you there is, how likely is that scenario for you? And two, where are you best protected as an investor then? In which sectors?
Well, that's a good question. I think that my portfolio is the same regardless. And I think for me, what makes most sense is 10% in gold, in physical gold, because that's just your insurance policy. I don't really look at gold as an investment. I don't look at it as a speculation. It's just something you always have just to maintain your purchasing power in an environment of deflation or inflation. Because especially with gold, usually you see that liquidity problem when the stock market crashes, therefore gold sells off. But over the long run, those assets or the stock market usually goes down more than the price of gold. So your gold, if you're trying to buy stocks with them, increases in purchasing power. So that would be first and foremost. And then second, I like to have 80% of my portfolio in what I consider investments. And the way I define that is something that would pay me to own it. So a cash flowing rental property, a good dividend paying stock. And people say, well, where are you going to get a good dividend? Well, you got to get creative. You might have to go outside the United States. You have to look at, other countries that have great companies that are producing a lot of cash flow that can afford to pay a 5 or 6% dividend. And then finally, in the last 10%, I think what I do is I look at speculations, and that's something that might not pay me to own it, but it's got a lot of asymmetry. So the gold miners, as an example right now, I think have a tremendous amount of asymmetry, but they might not pay you to own them. So that would be an example of a speculation. Even Bitcoin, I think it would be in that category. And although I don't like the price and I don't like the the emotion in the market right now, I like to buy things when there's more panic and a lot less hysteria, but I still think it would qualify for that speculative asset, and it may be something that's interesting for some investors.
In that portfolio, is there any space for cash?
Yeah, so that's the portion of the portfolio that's allocated. I think for every individual, they've got to come to a conclusion on what's right for them as far as their cash position and how much dry powder they want to have. Because, you know, I think the least counterparty risk you could have in a cash position right now is just to have T-bills, very short term, and just roll them over. Because if I had over 250, you know, above and beyond FDIC, I would not want my cash as a liability of the commercial banking system, especially considering what's going on with reverse repo. You know, so I'd want those T-bills. But you know, how much dry powder you have is really up to the individual, because the bottom line is, if you have a cash position right now, you're losing purchasing power. There's a negative carry to have that optionality. And some people, you know, they don't feel comfortable with that negative carry. Other people do. So I think that's really an individualized question. But as far as the percentage of the portfolio that's actually in play, that's how I set mine up. And I think that especially right now, you got to own some gold. You know, what's interesting is I talked to a lot of the guys in the deflation camp, you know, or I shouldn't say deflation, I should say disinflation, because those are two completely separate things. You know, it's just a slower rate of inflation, instead of a deflationist is someone that believes that consumer prices or assets are actually going to come down in value. And I would use Jeff Snyder as an example of that, someone who's an expert in the repo market, in the Eurodollar market. He's forgotten more than I'll ever know. But in private conversations with Jeff, you know, he'll sit there and say, yes, I'm a disinflationist, but I have a huge gold position because I know that the system's flawed. And at some point in time, we're going to have a monetary collapse, something greater than we saw during the GFC. It's inevitable, but it might not be imminent. You know, it's always a timing issue. But he says at some point we've got to go from this monetary system we have right now to what's next. And when we go from A to B, he says, I want to own gold.
But is it so? Do you believe it's the impact of the reverse repos exploding that will lead to that economic collapse? I mean, what will be?
No, I don't think that's going to lead to it.
Like, what's the trigger?
I think that might be the canary in the coal mine.
Okay.
You see, that's just kind of a warning signal that hey guys, something's off here. And and again, it's not that the financial collapse is imminent. It's just the market is telling us that the probabilities of a financial collapse, or like a GFC 2.0, or something like we saw maybe in March of 2020, is far greater today than it was 4 months ago, you know, prior to the Fed doing $1 trillion a day in reverse repo.
So also what I'm hearing from you, George, so inflationary or disinflationary, you like gold.
Yeah, that's right, or deflationary. And I think people have to look at inflation and deflation in 3 separate compartments. And this is, I think, a big mistake that people make, is they see inflation or deflation as just one thing. So if we have inflation, then all prices go up and the value of the dollar goes down, right? And if we have deflation, it's just the opposite. But it doesn't necessarily happen like that. In fact, it rarely does. You've got to compartmentalize asset prices, goods and services, and then the dollar against other currencies. Let's use the DXY as an example, which is 57% euros, right? So if you look at the last 2 decades, you can see many times where they're going in opposite directions, right? Where the stock market is going down, but yet the CPI, even measured by the government, which is low, is going up. While at the same time, who knows what's going on between the dollar and the euro and the DXY. And let's look at the 1970s. That's another great example. You know, we all know that was a decade of extreme inflation, stagflation, we called it. So, but from 72 to 74, the stock market went down by 50% in nominal terms. You see, so we had a massive deflation in the stock market, while at the same time, we had probably 10% plus inflation and consumer goods and services. So you've really got to compartmentalize these three things. Now, once you've done that, you ask yourself, okay, is the dollar going to go up or down compared to what? And if you ask me, George, compared to asset prices, I'd say it's 50-50, because it all depends now on the government and how much deficit spending they're doing to compensate for the lack of dollars that are being created by the commercial banking system. Going back to what we were just talking about. Danielle, if you look at a chart of commercial lending with the banks, it's actually gone down since all the PPP. So that means the dollars in the system should be decreasing. So how have we seen M2 go up by 25%, in 2020? Because the government comes in and deficit spends, the Fed monetizes it, and that creates brand new dollars, you see. So if we get this gridlock with the politicians and we don't get more and more and more stimulus, then I think asset prices will have the tendency, there's no certainties, only probabilities, but the probabilities are high that asset markets go down, because I think we've gone from a Fed put to a government put. And what I mean by that is, we started off with QE with Ben Bernanke, and it was just there wasn't supposed to be 2, 3, 4, 5, 6, 7, 8 infinity. And that's exactly what we got. And you'll notice that it's like a monetary drug. It's like Schiff says all the time, it's like a monetary heroin, where once you start taking that monetary heroin, you have to take more and more and more and more of the drug to have the same effect. Well, that's what we did with quantitative easing. And I think we got to a point in 2020 where they were pushing on a string and it wouldn't do anything else. So the government had to come in and say, okay, now we'll go ahead and take the baton, and we have to make asset prices go up. And the only way we can do that is with stimulus. So we've gone from QE1 to QE infinity. And I think that we're going to go from stimulus 1 to stimulus infinity as well. The problem is if we don't, because of that political gridlock, that's when you're going to have the deflationary pressures that are actually natural. And if we had a free market, that's what we'd see. We'd see asset prices come down because we've just got massive bubbles everywhere. But that's not to say that consumer prices would come down, because then once we move over to that bucket, people look at the demand side of the equation and they say, well, if people have fewer dollars, then that means, or less purchasing power, then that means that we have, the stuff at Walmart will be cheaper, or the groceries that I buy, or my rent will be cheaper. Not necessarily. Because if demand is going down, you're only looking at one side of the equation. If the supply side goes down faster than the demand side, then we still have price inflation. So people have to look at that. And then you say, well, what happens to the dollar on the DXY against the euro? Who knows? Because it's all just one fiat currency against another fiat currency. And we know that every single fiat currency throughout history has all had the same end game. And that's that they've all gone to zero. So,
yeah, but there's so much to unpack right here. So many good things you brought up, George. Bringing it back to your portfolio and how the Fed has been propping up, and it's just one big party. What they've done to asset prices. I know you mentioned Bitcoin as a speculative play for you within that portfolio, yeah. But does it not concern you how much of the Bitcoin price run up has to do with that liquidity injection? What happens if the Fed wasn't pumping so much money into the system? Where would Bitcoin be?
Yeah, that concerns me, but it doesn't concern me as much as sentiment. And that's when I go back to just buying panic and selling hysteria. Something that I learned from one of your guests, my favorite investor of all time, Jim Rogers. And that's one of the things that has made him great. And if you look at Bitcoin, yes, I think there is a lot of liquidity coming into the market that's driving the value. I think it's doing that with everything. I think that's happening to home prices. It's definitely happening to stocks. But what Bitcoin's very interesting because you don't have a way of measuring it in terms of cash flow. You don't have much historical analysis. Like, oil, if you ask me if that's cheap, you can go back 100 years and measure, just for inflation and determine when it gets cheap, when it gets expensive. Bitcoin's tough. So I think with Bitcoin, what I do personally, and I'm by no means an expert, but I look at market sentiment. So if I turn on CNBC, and every single commercial is about Bitcoin, and every single talking head is sitting there saying that you should go out and buy Bitcoin. And not only that you should buy Bitcoin, but some of the quote unquote, we'll call them pros to use that term loosely, are saying to not only buy Bitcoin, but buy it on leverage. Take your credit card out, and we see CEOs of corporations actually doing this, buying Bitcoin on leverage. That's not panic. That's hysteria. And that's when I want to be a seller. I don't want to be a buyer, even though my long-term position or my long-term view on Bitcoin may be bullish. At that time, I just want to step back and just see how it all plays out. Now, if we get to a point where CNBC stops covering it, it's, oh, that Bitcoin thing, yeah, everyone lost a bunch of money on that. Yeah, it's just for those libertarians. It went up twice already, and we're not going to be burned again. And once you start hearing your friends and your family members and the people on CNBC start to say those things, then for me personally, that's when I start to get interested in it again. But that goes for most asset classes.
That wraps part one of my discussion with George Gammon of the Rebel Capitalist. Stay tuned for part two, where we talk about the coming of the Fed coin and what it means to you. In the meantime, remember to sign up at stansberryinvestor.com to not miss any of these videos, and DanielaCambone.com for premier access, special videos you can't get anywhere else, special offers, and a lot of other exclusive great stuff. Register free today.